Everyone. So I just wanted to discuss a problem. Um, it's problem E9-21 in your book, or part of your homework assignment. The learning objective of this problem is applying the allowance method for uncollectibles and estimating bad debts. So the thing with this problem is that companies sell to the customers in cash or on account. Recall that sales on account are those where the customer promises to pay the company at a later date. Sales on account create an accounts receivable asset for the company. Accounts receivable, also called trade receivables, represent the right to receive cash in the future from customers for goods sold or for services provided or performed. Selling on account brings both a benefit and a cost. The benefit to a business is the potential increased revenues and profits by making sales to a wider range of customers. The cost, however, is that some customers do not pay, creating uncollectible receivables. The customer's accounts receivable are an asset. Accounts receivable that are uncollectible must be written off, which means they must be removed from the books because the company does not expect to receive cash in the future. Instead, the company must record an expense associated with the cost of the uncollectible account. This expense is called bad debts expense. There are two methods of accounting for uncollectible receivables and recording the related bad debts expense. The first of which is the direct write-off method. The direct write-off method of accounting for uncollectible receivables is primarily used by small, non-public companies. Under the direct write-off method, accounts receivable are written off and bad debts expense is recorded when the business determines that it will never collect from a specific customer. So in this case, it would be a debit of debt expense and a credit in accounts receivable. The explanation for this journal entry would be wrote off uncollectible accounts. Occasionally, after a company writes off an account, the customer will decide to make payment. To account for this recovery, the company must reverse the earlier write off and then will record the cash collectible as follows. It would be a debit of accounts receivable, a credit in bad debts expense, which would be a reinstatement previously written off account. Then it would be a debit in cash and a credit in accounts receivable, which be the entry for collected cash on account. The second method is the allowance method. The allowance method is based on the matching principle. Thus, the key concept is to record bad debts expense in the same period as the sales revenue. The offset to this expense is a contra asset account called allowance for bad debts. The allowance account reduces the asset accounts receivable. The business does not want to see which customers will not pay. Instead, it records a bad debts expense based on estimates developed from past experience and uses the allowance for bad debts to hold the pool of unknown uncollectible accounts. When using the allowance method, companies still write off accounts receivable that are uncollectible. However, instead of recording a debit to bad debt expense, as done with the direct write-off method, the company will record a debit to allowance for bad debts. Bad debt expense is not debited when a company writes off an account receivable when using the allowance method because the company has already recorded the bad debt expense as an adjusting entry. The entry to write off in an account under the allowance method has no effect on net income at the time of entry. So the journal entry would be a debit in allowance for bad debts and a credit in accounts receivable. This journal entry would be because of writing off uncollectible accounts. Customers will occasionally make payment on receivables that have already been written off. A business will need to reverse the write-off to allowance for bad debts account and record the receipt of cash. In reversing the write-off, the business is reestablishing the receivable account and reversing the write-off from the allowance for bad debts account. To do this, it would be a debit in accounts receivable and a credit in allowance for bad debts, which reinstates the previously written off account. Then there will be a debit in cash and a credit in accounts receivable, which will be the entry of collecting cash on account. So if we look at the problem, right? During August 2018, Lima Company recorded the following: sales of 133,000, 122,000 on account, 11,300 for cash. Ignore the cost of goods sold. Collections on account would be 106,400. Write-offs of uncollectible receivables would be 990. Recovery of receivable written off would be $800. In requirement 1, Lima's transactions would have to be journalized for August 2018, assuming Lima uses the direct write-off method. In requirement 2, you'd have to journalize Lima's transactions during August 2018, assuming Lima uses the allowance method. So if we look here for requirement 1, we have the sales. We have sales of $132,300, $122,000 on account, $11,300 in cash. And I said before, we ignored the cost of goods sold, recorded debits first, then the credits, and the explanation. So the journal entry for this will be a debit in cash, 11,300, a debit in accounts receivable, 122,000, and a credit in sales revenue, 133,300. The explanation for this journal entry would be recording sales for the month. So now we have a collections account of 106,400. Collections on account are also recorded the same way, regardless of the method in use to account for uncollectible accounts. When collecting it on account, the company will increase its cash and will reduce its accounts receivable. So in this entry, we have a debit in cash, 106,400. We have a credit in accounts receivable. For this journal entry, we're collecting cash on account. Okay. So the next entry would include what's it? Write-offs of uncollectible receivables of $990, as you see here. So write-offs of uncollectibles in this requirement, we are asked to prepare the entries under the direct write-off method. Remember that under this method, accounts receivable are written off and bad debts expense is recorded when the business determines that it will never collect from a specific customer. Record the write-off under the direct write-off method, we must increase the bad debts expense account and reduce the accounts receivable by the amount of the write-off. Now in this entry, it would be a debit in bad debts expense of $990 and a credit in accounts receivable of $990. Then the explanation for this entry, we wrote off uncollectible account. Now we have the recovery of receivables previously written off of $800. To start with this entry, we prepare the entry to reinstate the receivable. To account for recovery, which is when a customer decides to pay for a previously written off receivable, the company must reverse the earlier written write-off and then record the cash collection. To begin, we'll reverse the write-off by debiting accounts receivable and crediting bad debts expense by the amount recovered of $800. In this case, it will be a debit in accounts receivable of $800, credit of bad debts expense in $800. The explanation for this entry be that reinstated previously written off account. Now we must prepare the entry to show the collection of the previously written off receivable. The last part of recording a recovery of receivable is to show the increase in cash and the reduction of the accounts receivable that we reinstated with our previous entry. So in this, we'll have a debit in cash of $800, credit in accounts receivable of $800, and the explanation includes collected cash on account. Okay, So on to requirement 2. So in requirement 2, be journalizing Lima's transaction, assuming Lima uses the allowance method. So it'd be pretty similar. We have um, sales of 133,300, 122,000 on account, and 11,300 for cash, ignoring the cost of goods sold. Remember that this method used for accounting for uncollectible accounts will only affect our entries to record the write-off of receivables and recovery of the write-off. The entries to record the sales for the month and the collections on account will be identical to those same entries that we prepared in requirement 1. So be a debit in cash of 11,300, debit in accounts receivable 22,000, and a credit in sales revenue of 133,900, the sum of 11,300 and 122,000. And this entry is for recording the sales for the month. And we have the collections on account of 106,400. We will have a debit in cash, 106,400. Credit in accounts receivable, and that is because we collect cash on account. Okay. Now we have a write-offs of uncollectible receivables of 990. You see here. So our first difference between the two methods starts with this entry to record the write-off of uncollectible accounts. Under the direct write-off method, we debited the bad debts expense and credited accounts receivable. When using the allowance method, companies still write off accounts receivables that are uncollectible. However, instead of recording a debit to bad debts expense, the company will record a debit to the allowance for bad debts. Bad debts expense is not debited when a company writes off an accounts receivable when using the allowance method because the company has already recorded the bad debt expense as an adjusting entry, not shown as part of the problem. But now we will go ahead and prepare the entry by debiting the allowance for bad debts account and crediting the accounts receivable account. So we have a debit and allowance for bad debts of 990, credit and accounts receivable 990. And here we will be writing off uncollectible accounts. So now we have the recovery of receivable previously written off. So we look here in the amount of $800. Remember that the process of recording a recovery of a previously written off receivable requires two entries. First, the company must reinstate the receivable, and then the company must record the cash collection. Refer to the preceding journal entry as we did before. Note that when the company wrote off receivables, it debited the allowance for bad debts account and credited the accounts receivable account. To reinstate the receivable, must reverse the previous entry for the amount of the recovery of $800. So now we have a journal entry of debiting the accounts receivable, 800, crediting the allowance for bad debts of 800, and then we reinstated the previously written off account. Okay. So now in our final entry, we must show the collection of the previously written off receivable. For this entry, it will be identical to the entry prepared in requirement 1. To show the collection of the previously written off amount, the company debits cash and credits accounts receivable for the amount of recovery of $800. So it's going to be a debit in cash, 800, credit in accounts receivable, 800, and our explanation includes collected cash on account. Okay, so that concludes the problem. And that also concludes the video. Let me know if you have any questions for this week in this chapter 9. There are 3 problems, one of which we will cover a similar problem in our usual Google Sheet groups. This is the second problem, and I would like the third remaining problem to be done on your own. Feel free to ask me any questions. Also, feel free to ask me any questions related to the quizzes after you have finished an attempt. And thank you for watching.